Hello, good morning everyone. Today we are going to review the different setups that we can create using an exponential moving average. We will start reviewing the EMA setup and how can we use it in favor or against the setup when we have an instrument where we cannot find a good working configuration. First of all, let's review how this setup works. We have a moving average, the middle line. I will add a standard exponential moving average. On this example, we are using the custom indicator EMA with a period of 34 and an envelope of 25 ticks. We have 25 ticks between the moving average and the up or lower lines. So now I will add an EMA with a period of 34, and we can see that the entry line is just over the EMA because on this configuration we are using an offset of 0. We can change that offset on the setup. Here we have a short and a long. If we use a positive offset, let's say the half of the envelope, 12 ticks, then we have an early entry closer to the lower channel. This is an early short, an early long, and if we make it almost close to the channel, to the envelope, let's say 22 ticks, now we can see that we have entries almost over the envelope. If the offset is negative, let's start again with the half of the size, then we have a delayed entry. And we can also be close to the upper channel. So with this flexibility, that means that we can trade bounces over the moving average with an early or delayed entry. And also, if we have an instrument or a combination of instrument and time frame where nothing looks like working, we can invert the signals. So everything that was a short converts into a long, and so on. Let's restart everything to the default so we can explain the logic, because not always we are in long mode or short mode. This is the function of the envelope. When, as we can see, these bars are gray, and while it is inside the envelope, we don't have signals. Once we touch the upper envelope, then we are interested in entering long at the moving average plus an offset. The same for the short side. Once we enter one signal, we reset the condition again, so we need to touch again one of the envelopes, like here, to be trade ready again. So we have a short over the moving average plus an offset. When we have a trending market, like Dow Jones or almost any index, the standard moving average like 34, 50, 100 usually work very well on most time frames, usually using an offset of 0. On this example we can see that we have a very good performance. Just to have an idea, the horizontal lines are 10 ticks one each other, so we can calculate the needed stops and the possible targets that we can get. On this example, we need more than 10 ticks, something between 15 or 20 ticks of stop. And for the targets, we can start something between 10 to 15 ticks. Here we have at least 20 ticks. Here we have a long, it worked. This short at least had 10 ticks. All this area is on sideways, so we don't have signals. And here we have an example where the trend changes and the last signal was a loser. So it is very difficult to get a target here. And same happens with this short. So these are two losers. But we are coming from a very good uptrend with 3 very good trades. Here we have a short, a small long, maybe a loser or maybe a target one, another long and another long. If we change the time frame from range 6 to ticks, which is also very useful for index markets, range 6 is similar to 300 ticks. As we can see, almost nothing changes. We have the same signals. Here we have the same two losers after the good uptrend. And as we saw, this setup is very good for trending instruments. Let's go back to range 6. The advantage of using a range bar type is making the volatility constant, so we can change between different volatile instruments and we can keep the same shape on the chart. The only difference is the number of ticks or the duration of the bars. If we now change to DAX, which is much more volatile, first we can see it is much more difficult to get good response to bounces on moving average. One of the main difference on this instrument is that if we change this to 300 ticks, now we get a very short chart, very small, very slow, because the equivalent on ticks is something similar to 100, maybe 50, something near 65 ticks. So here we have something similar to what we got on range 6. Almost the same shape. So that means that on Dow Jones one bar is 300 ticks. Here we have only 65 ticks, almost 5 or more times the number of transactions. So it is more volatile and we may get worse fills. As we can invert the logic of the setup, instead of buying bounces on the EMA, we can trade breakouts of the moving average. So we invert the logic and we trade the breakout of the moving average, and changing the offset we can make the entry earlier. To have an early entry we need a positive offset, let's say half of the envelope or almost near the envelope. We can fine tune how close we need the entry from the envelope. The idea is to trade from the envelope towards the moving average, that, as we know, there is no good bounce over the moving average, so we can estimate a bigger target. So that will be the size of our trade. For the short we have a bad long, but then this long has worked very fine. That will be trading against the EMA. Here we have a short, a long, short, short, and two longs. So we wait for a breakout and then trading the return to the moving average. So on a trending instrument we should trade bounces over a moving average, but on volatile instruments like crude oil or DAX it is more convenient to trade against it, and possibly adding an offset. If we want to trade the standard EMA we can use a negative offset. So let's go back to the standard EMA, but now with a negative offset. Maybe a small offset, so not exactly zero but something negative, let's say half of the channel. And now we can trade with the moving average but on a delayed entry. So we can trade along here, with a possible target that is a little more than the middle of the channel. This short is very close to the this may be possibly a loser. A short, long, a long. This short is a loser. So as we can see we have a lot of options, and we are just using a moving average and a channel. So for an index like Dow Jones, Nasdaq or Standard & Poor's, we better try to use bounces over a moving average with an offset of 0. For volatile instruments it is better to trade breakouts, so we invert the logic and use a positive offset. Hope this video has been useful for you, and if you have any question or comment please post below this video. Thank you everyone, bye bye.